we want to make sure that, there you go. We want to make sure that you can have access to all the wonderful information that's going to be shared today, to be able to reference at your leisure. And what we're also asking you to do, just to minimize disruptions throughout these sessions, is please stay muted while the presenter is speaking, and we're going to ask you to hold all your questions to the end of the session. So now that that is out of the way, on behalf of the credit union, thank you so much for taking time out to join us today on this very, very important topic on retirement planning. A lot is happening in our market right now, and with adjustments and changes to the NIS scheme, we think it's very important that people are armed with all the information and knowledge that they can make the strategic decisions they need to make to have the best retirement. Now I'm going to invite you to please pay close attention to everything that we say this evening. We're going to have a very short quiz at the end, and somebody's going to get a chance to win a $50 credit union cash voucher. So very worthy of your attention, please. And the question is going to be very easy. It's just going to be based on something that was shared today. So hopefully, you keep your ears kind of focused on what's going to be shared today. Now, usually when I have these sessions, I don't like to presume that everybody who's joining us is familiar with our credit union. And therefore, I just want to share a little bit of information about who we are. So the BW Credit Union, we've been in operation since 1983. And we're very close to celebrating our 40th anniversary. It's going to be coming up on July 8th. Now, with just about 30,000 members and probably just over 200 million in assets and growing, we are one of the largest member-owned financial institutions in Barbados. And we have branches located in Bridgetown, Speightstown, and Oyston, so almost all the towns. Now, we offer a full range of financial services products, including enhanced and premium saving options. And in fact, we've recently introduced our new Smart Living Retirement Savings Account. And so this is an additional option to our registered retirement savings product. And that particular new savings option comes with tiered interest rates, which means basically the more you save, the more you can earn. And we also have a range of quality savings, alternative savings products for you to consider. Now, clearly, saving for retirement is extremely important. Thankfully, we're all living, more active and productive lives for much longer. But that now also means that, we have to consider that we might need higher income levels in our later years so that we can ensure that we can have a comfortable and happy lifestyle. Unfortunately, as I said before, the NIS scheme is under tremendous pressure, and the benefits under this program may not be guaranteed. I mean, we want it to be, we're all praying, but, we have to do our utmost to kind of make sure that we, we prepare ourselves in the best possible way to have a very content and happy retirement. And so basically that's what today's session is all about. We are very pleased to have been able to secure Mr. Roderick Nurse as our featured speaker today. And he's going to be sharing some worthy advice and tips to help position all of us for the retirement that we truly deserve. Now, just to give a, just be able to introduce Roderick so you know who you're dealing with. He's an insurance sales advisor by profession and also qualified financial services specialist. He's also chairman of the Barbados Association of Insurance and Financial Advisors. Roderick holds the designations of Life Underwriting Training Council Fellow, Financial Services Specialist, and Chartered Life Underwriter. Throughout his many years in the insurance sector, he has served on the board of directors of BARAIFA, its educational committee, and was also chairman of the Bylaws and Legislation Committee. Outside of his professional work, he's the vice president of the Barbadian Families and Friends Relocation Association, with responsibility for training and development. And some of his projects include the Care of the Elderly and Caregiver Community Program, Managing Money for Secondary School Teens, and the Primary School Stationary Aid Program. And if that wasn't enough, he also volunteers with Parados, and he's a facilitator of the financial planning module of parenting class, and he also serves on their board of directors. So he is clearly well experienced and well served to be able to kind of present very capably on today's topic. So without further ado, thank you very much, Roderick. The room is yours.
Thank you. Good evening to everyone. And as we go into looking at retirement planning, I'm going to have a particular focus on retirement income planning. And I'm going to touch a little bit on the national insurance and the annuities. The approach I will be using there is what in the retirement planning circles we call safety first. But I want to go back even when I look at the topic and just to spend a little minute on that, and we'll do a little reflection as to where we are at, just to shape the perspective a little bit. And we look at the regulatory framework. What I've opted to do this evening is a little different from how I normally present. I'm going to share in a way that I can kind of give the resources so you can find the resources for yourself, because in retirement, you really need to know the direction that you're going in. So we'll go from there. The hope is that I will do more fielding the questions that you may have, that I can address the issues that are important to you. Depending on the age you are at, then your effort towards retirement will be at different rates. And let me say that the challenges that you will find that you will face in retirement are no different from the challenges we face today. And I just want to share a little bit. I just want to go to one screen and let's share this one. Right. A lot of our training is done in Canada and it is done in Canada. You can see the screen?
We can see it, Roderick.
Okay, good. Unfortunately, I don't have my second monitor, so I can't see what's on the screen, and I was actually fighting to get that up and it didn't work. So that is why I was definitely a little distracted at that point. So if I'm talking about something that is not there, then Valerie, you could always shout me and let me know then that the others can't see.
I will definitely do that.
Right. This gentleman, Professor David Little, he did this paper. It's actually on the internet, and I thought it was useful, and I actually just copied down the resources, where he's looking at 18 risk factors we face in retirement. And the major one is outliving resources and the risks associated with aging, and the investment risks is one of the areas that he touched on. The challenge we face in this country is that the challenge faced by the world is that investment risk has been a significant challenge across the board. And the issue we face with that is that we are at a time where we were facing two types of risks: the interest rate risk, and I copied this one, and this is actually from the statistical department, where it showed what the interest rates were like in 2007, and the interest rates actually in 2021, and it is pretty much to zero. The challenge with the investment rate risk in retirement, and we are facing it before retirement, is what you can see here. So when we are talking about a drop in the interest rate, and this is 7 years, a person investing $100,000 at 5.25%, the interest earned is $44,000, as opposed to you being in an environment where you are getting nothing on the savings, and you end up then with only, after 7 years, you've only got $465 to deal with that, to address your needs. So part of the challenge we will face even before we get into retirement, and what has been facing us what we've been dealing with for the past few years, would have been that interest rate risk that can occur at any time. When we look at market risk, which is an area that impacts all of us, is what probably this one will bring to mind, and I hope and I have the right one. Apart from the drop in interest rate and the financial collapse we had since 2008, we then had our own challenges locally. And not to knock the institution, but this is a proposal that I found to deal with a retirement plan. And this person is actually a female, age 34. So the whole notion of setting aside money for retirement is something that is quite familiar to us as a people, and efforts have been made in the past. and they continue to be made to see how we will look to address our issues. I look at the interest rate being around 0.65%. If you have, you'll probably get a little bit more, as Valerie spoke about the savings plan that has been happening. And even if you examine the market, part of the reason that has been happening is that the old familiar registered retirement savings plan, that plan is in trouble right now. And it is, I shouldn't say in trouble, it is not giving any kind of returns, and there's a little complication. I want to back out that and correct it. Valerie, sorry, I couldn't edit it, but I can't. It gone out already. So let me deal with it. It's a little bit of trouble in the sense that if you are going to invest in the instrument, not the instrument is in trouble, but the tax incentive that was associated with that instrument has been removed, but the tax penalty for early withdrawal is still there. And you end up in a situation where you're double taxed. So it is not the preferred instrument. However, if you were with say you were with a company plan and you want to change your pension in from a company plan, that is the only instrument that you really can move a company pension plan into. And even though I wasn't dealing with that yet, but I need to clarify it since I criticize it a little bit. The instrument in itself can work. The challenge comes when you want to, if you want to withdraw money from that particular instrument, in that the rules that are still there provides for 25% of that money to be taken out tax-free. But if you're touching the other 75% is where then you will kind of get that penalty. The challenge where I, as an advisor, may not want to recommend it to a client at this time is because you don't want a case where you have money that is restricted if a person needs cash, especially in a time where as a country we've been seeing a little bit of difficulty. So I just wanted to clarify what I mean in that regard. So this particular plan is the flexible premium annuity, and like I said, this is a lady aged 34 years old. This is back in 2001. And the challenge we face comes out in this particular plan. And it is one where we don't recognize how long retirement will last and how long our money should last. But as I have this up, we can see the current interest rate at 8.50%, which is really high. So in a situation like this, where the lady, she deposited $2,000 and she's paying $100 a month, you can see where when she reaches age 70, she would have put in $45,000. This plan was saying that the growth, the guaranteed cash value, would have been $95,000. But at the current interest rate of 8.5%, you were going to have some fantastic returns. 8.5% as opposed to what we are seeing now. The plans tend to be no more than probably 2.53%. They're still pretty low. But this is what you're looking for when it comes to the pension, because the accumulation phase is one side. And very often it is important to get a clear idea of how the markets are performing, because what you are really looking at is this element of it, where you know how much money you are getting, and that will be coming in on a consistent basis. So the registered retirement plan, just like the company plan that you will have at the workplace, would be one aspect of how you can secure an income for life. Obviously, you know, the promise could not have been made good, because CLICO, unfortunately, the company failed in that regard. Now, what that failure brought about was a fear in the market. So if you think about the CLICO failure, and then coming a few years later, you end up with the adjustment, the government made adjustments to the bond. It again meant that the instrument that people invested in, that lost its value, and that had significant repercussions not only to the individual but also institutions. And it is that move that then resulted in a number of companies moving away from, say, the RRSP. Even we had a bank that opted to end the RSP as a product and basically call clients and ask them to take the money and put it someplace else because they were no longer pursuing that kind of business. So if we look at the country on a whole and we look at the time we have to go into retirement, we realize that we are not in the best of shape going into retirement. So the question is even a greater one as to how now do I prepare myself to deal with the challenges that do exist even before I have gone into retirement. And this is one of the things that I definitely want to look at. One of the concerns that I have is when even we talk about retirement planning, how long in the future are you looking to plan? And if you are going to be serious about planning, you have to plan and expect that you would live until about 90 or 95 years old. That is the kind of planning that you have to take into consideration. And sometimes at that kind of age, definitely past age 80, you're going to need the assistance of a person, of family members around you, and cash will be a concern that you want to have the cash ready. We might be fortunate, or some of us may be fortunate, like Mr. Clark, that I know he's actually 98 years old, and I went by him. And I showed him, I said, well, Mr. Clark, what's happening? And he said he was good. Mr. Clark walked down the stairs at 98 years old, went by the domino table, pulled a seat and asked the other fellas, you guys not playing dominoes this evening? Because that is his pastime and he can do that at 98, a very strong 98. But what was surprising is that when he was in his 70s, 70, 78, going towards the 80s, he was extremely sick and hospitalized, he was hospitalized for a while that honestly, we really felt that, he wouldn't have made it past a couple of weeks. We were kind of looking, not expecting it, but he had looked like if a funeral would have been close at hand. You see, what we benefit from is the advancement of medicine. And that then has increased the longevity that we have. But as you are going into that phase of life, now you realize that the need and dependency upon your loved ones become even greater. This then is a part of the risk that I deem to call, a term to call a relationship risk, where you find people in the, say, the 40s, 50s, and age 60, they now are at the point where they have to care for their parents. Unfortunately, a lot of the parents at the point in time did not have adequate provisions, may not have had health care in place, and they were really dependent upon the state to address a number of issues. So you find where you get a person, I'm saying in the age group of 40s, and why I start 40s is that the majority of people will tend to start to think about retirement seriously around that age. And if you think about what's happening around the age 40 age group in our side of the world, at age 40, you've just come out of, or are coming out of, dealing with your child's, the expense of your child's education. If your child was at university, you paid that money and you're looking to recover. One of the instruments that I find you will also have is the mortgage. A lot of people around that age, they're still paying a mortgage, and the aspect of mortgage interest is also important as well. And I'm not looking at that. There is one slide I was hoping to. As I'm talking about mortgages, there's one slide I wanted to get. I didn't bring this one up before. Debt, and don't let me jump. I was saying that if I'm looking at the 40s, then there's certain things that you find you're in the accumulation stage, but you would have gone in, you may have had your house, or you're looking at getting the house, and you find that you may be engaged in that. But what I want to look at is the change that has occurred in our society, which we need to be very mindful of, even as we look at retirement. This is the mortgage as a percentage of the gross domestic GDP. But I'm not assuming an economist, you don't have to worry about that. But if you look at this chart and realize where it was in 1973, 1979, and you move to 2000 and you move to 2015, you would realize that the way we finance is debt with debt. And the way we look at having houses today is the whole aspect of having debt. And we'll look at this a little bit because when you are engaged in debt, there's the interest component that can be significant in terms of how we will look to manage this. So I'm saying that, yes, at that age, the children are, you're at the point now where the children, the expense of the children are not there. You're still dealing with the mortgage. At a time now when your parents are not, can be in a situation where they have a need for not only your time and attention, but also your financial, your money to be able to support them in that regard. What I've done is I've done some checks to see what, for example, nursing homes charge. Nursing homes can run you anywhere between, say, $3,000 and up. If you have to get a nurse coming in, and remembering that minimum wage is $8.50, and for 8-hour day, that can be $68 a day. But they tend to run between $10 and $12 a day. And if you're getting a registered nurse, you can be up to $20, $25. So the prospect of looking after the elderly person does call for some resources. And I think we will remember that just recently, the government, the minister, I think it's Kurt Humphrey, made the point that the idea of looking after the elderly within the community and within the homes, aging in the home, will become a part of our landscape. So it means that for persons having to go out to work, that is going to be a challenge. So as you look after your relationship, you look after the parents, and it means then that there's a greater emphasis that if you're going to put money into your child's development, that you want to make sure that the child is responsible. And very often we may find that, you know, we may need to intervene when it comes to counseling. There are facilities like the same Paradox I talk about, where we're looking at helping parents in the understanding how that child should develop, that you give yourself a good chance of having a responsible person going forward. There's the early childhood courses, that those are some of the things that you may want to take at this time. A child that is disobedient or you can't control at age 10 will tend to be an underperformer when you start to get into the secondary and tertiary level aspect of it. So how you manage the relationship within your household, even though it doesn't have a direct financial a dollar sign on that, is significant as you look to prepare for retirement. The other areas that really would have been mentioned a lot in the course and the courses over the time, which at first was a surprise to me, was that whole element of family law when it came especially to divorce planning, their cohabitation agreement for those that are looking to live common law. Because you do find, and especially I remember hearing a credit union leader indicated that when it comes to the majority of non-performing loans or more default on mortgages, a significant part came about as a result of the relationships in terms of the dissolving of those relationships. So that the division of property becomes an important aspect of it. And I found that in North America especially, that whenever we were doing planning, then the prenuptial agreement and the cohabitation agreement came into sharper focus. We have a similar problem here. And the challenge with the whole aspect of divorce, especially when there's a mortgage, is that sometimes you see some properties being sold well below value because now the banks, you know, want to get disposed of those properties, or the two people decide, you know what, we can't get this thing going together, and therefore that happens. So even before you get into retirement, there are two aspects that you want to manage, and that is the market risk, of which I'm saying the aspect of that is diversifying, looking for opportunities, say that you can put your money in, I don't want to say high savings account, but at least the best savings you can get. Years ago, 4% was scoffed at. No, it's 4%. You know, we can't wait till 4% savings come back. So maybe Valerie can hear me and hear my prayer. 4% is really, really good. That is the challenge we face, and I think we are up for it as a people. This is not the first time we've been this way. We've been this way before. In the 60s, remember, there was a lot of migration that happened up to the UK, and even people coming back now. A lot of the houses and the returning nationals you find that the wealth was created and there was repatriation of funds to help us as a people. What we have going for us as well is that we have an educated population, and a population that, to my mind, is better prepared than, say, our parents were for the world ahead. So there's no need to fear. But sometimes I like to define a problem and a challenge this way. You see, if there's a lion facing a man and the man has a gun, a loaded gun, I call that facing a challenge. But if that lion is facing a man and he has a stick, I call that a problem. What is your capacity to reasonably succeed? And, sessions like this would also be helpful. But I want to look at the resources available to you, because if you are going to succeed, it's important that you understand the markets that you are working in and what are the risks necessarily associated with the markets. Part of the challenge that a CLICO resulted in was undermining confidence. And insurance is one of the products that you will need to take forward as you look at managing risk. There's no other product designed for that. But I do have some people who, and which I can understand, they're nothing to do with the insurance companies. In terms of where the regulation comes, and I want to just touch on that a little bit. The central bank is responsible for the regulation between the banks. The credit union and the insurance companies, they are regulated by the Financial Services Commission. And if you talk to any person, well, we don't have to talk to any person. The reason right now that the credit union, before they do business with you, need the proof of address and calling you around and saying you need to verify all of this AML document and CFD document, is not because they want to. We have to. We have to. The regulations now are so tight that the errors that occurred in the past, you guys are just making sure that the likelihood of those occurring, has been reduced. In the Insurance Act, and I have highlighted this one under the statutory fund, it does emphasize the importance that every company carrying a long-term insurance business in Barbados shall place in trust in Barbados asset equal to its liability and contingencies reserved with respect to its Barbadian policyholders. Okay. What it means is that in an insurance policy, and you have a cash value, and let's say that cash value is $20,000, then you can just, you mean, it was good. Then sufficient assets must be held to ensure that that money that you have due to you, either the cash value or if it is a death benefit that is payable, that money can be had. So when a CLICO collapsed, for example, the statutory requirement was still in place. Unfortunately, the regulators did not ensure that the statutory law requirement for the law to be in place was there, but the actual fund created the problem. But it meant then the regulators and who were the person responsible, basically government, had to ensure that the law was upheld. So even though you had the wind up of the insurance company after Res Life did not work, the bonds were transferred based on the value that was due to the persons at the point in time. And I do know that people are benefiting from those bonds. It was not a situation, for example, a trade confirmers or BCCI, the Indian bank that was here, where there was no obligation by government to make good in terms of in keeping with the law. And it is because of the structure of the insurance product and what is held there. Insurance companies, and this, let me touch this as well, I'll come to it, or the insurance companies themselves will also look at regulating pensions. So where you have the registered retirement savings plan, whether that plan was held in a bank, credit union, or it doesn't matter where, at maturity, those funds will turned over to the insurance company, and that will then be used to buy what is called an immediate annuity. The immediate annuity, and I'm going to come back to that in a little bit, because that is one of the tools, one of the products, the financial instruments that we will use in creating that safety first kind of platform to ensure that you can have an income for life. Let me also say too, and I after I shift from the insurance, I want to look at even within the banking system, that under the Barbados Deposit Insurance Corporation, and we can see that this act was established, and I hope everybody can see it, that this act was actually established. Maybe I can just do this a little bit, increase the size a little more. This act was established in 2006. And what this does, and it says here, it commenced operation January 8th, 2007. It provides insurance coverage up to $25,000 for deposits of commercial bank, as well as deposit taking trusts and financial companies. So I'm saying if we look at our the stability of our institutions, a lot has been done and a lot continues to be done to ensure that that holds true. The credit union, within the FSC, there is legislation and there is close monitoring to indicate that the funds are safe. In a case where the credit union, and we've had a few cases like that, where a credit union may not be operating at its optimum, then the FSD will assign a manager to go in and help resuscitate that credit union, so that you find every effort is being made by the regulatory players to ensure that you can be quite comfortable that the money you invest in when you're dealing with the financial institutions, that you can have a measure of confidence. I must say though that we continue though to see the growth and development in the market, and which is a good sign. If you're looking though, there are some sure things that when it comes to planning, I don't think we can get rid of. And I'm looking at the time because I want to definitely some time to chat. So I'll just try to wrap this up in another 10 minutes or so. There's actually a small video, it's like 2-3 minutes. And to me, if you're looking at retirement planning and you're looking at having that income for life, then to my mind, this is a good example of what we would want to do. I know every household will not be able to do it, but let's see if I can get this started so you don't miss a whole lot. Let me apologize for that, this interruption, which I thought these phones were off, so let me apologize for that. Let me reduce the. Let me look at starting this video. It's just a couple of minutes. If anybody's looked at the, let's go back and let me stop share this. Didn't have to stop share. Let me go to new share. Let me look to find this video. Right, okay, you can now see that. Great.
I was scrambling to unmute, but just confirming that we were able to see the video. I guess what you could do is put it into full screen.
Yeah, it will go into full screen. I just had, Zoom that bar is at the bottom.
I was growing up in like my early teens. My mom, who is Mrs. Vilma Carter, she's now deceased, and my dad, Reginald Carter, both deceased. They all live up in their 90s, so it's only about 3 to 4 years ago that, they're gone now. So we are trying our best to carry on the business. And as growing up, I saw my parents working very hard. My dad used to work at Lower State, and he used to be painting down there for a long time. And like the big tall house I could remember, Mommy used to always be praying that it doesn't go up and fall, because he would go up there and paint all of those, the house and things like that. And as we were growing up, my mom, she always liked to, she said from a child, she used to like to make little mud cakes and, put them in this little thing, and they would pretend that they're serving them to their, siblings and things. She always liked making cakes. So she just started in her kitchen. We were not always on this spot here. We were further down the road where you see they have the pharmacy. We were on top of that hill. But then we moved up to this location here, and my mom, when she was down there on the hill, she started just making sweet bread, and the boys on the bridge would come up on Saturday and Sunday nights and, start buying these little sweet bread and cakes. And she started with just a small amount of flour, like a 25, and then pounds, and then she went to about 50, and then a bag, and, she started like that. She didn't even have a big oven. She would make the bread after a time. The demand for the bread came more. So she would make this bread, and my dad, he had an open back red Datsun van. So they would pack all this bread on the van, and we would go to Britain's Hill to a guy named Dennis. He had a big brick oven, and they would bake the bread and bring back the bread, and sell the bread. That's how she started. So as she went along, and she got her own oven and thing, and it was even there out there that she learned how to do like the salt bread and the turnover. And at that time she didn't know that was a blessing in disguise. And salt bread now is our biggest seller, because they moved from a bag, and now some days they make 20 bags of 2,100-pound bags of flour a day in the bakery. And most of it is usually salt bread. The people kind of like Carter's salt bread a lot. They always, come and get the bread. And my mother was like a real person who would persevere. She never give up, always trying. And my dad would help her also, as they come along, they work together. And that's how Carter's Bakery really was established in the early days, when they would, be there, would just be helping around the place, helping mother, that kind of thing. My sisters as well, brother, I have one brother, and we would all be helping. And that's how we came along, because of, well, mom's vision, because she always had that vision that she would like to, own her own business, and that's what she worked towards.
Good news, the family business continues today. This parish holds.
Right. What I like about that is the way in which, if you look at retirement planning, I don't think Ms. Carter had to depend upon NAS, or she's concerned about what NAS is doing other than paying it for the staff. Right now, she has about 50 staff. The staff members will have mortgages, they got loans. So you can see that in her attempt, and I mean, this is where the mom started from home, looking to establish business. She then not only was able to provide for her family, she went on, but the business remained. If you're looking at seriously ensuring that you can maintain a certain quality of life, then establishing a business or having some means of income source, external source of income, is really one way of trying to address some of the market risk. Everybody will not be so skilled. But I do find that there are a number of people that have gone that route. There's a young lady, she works, I see her in a corporate office, she looks really nice. I went up Oystains and I saw her up there. She actually runs one of the stalls at night. I remember a few years back, I went to the bank and I saw this young lady, she dealt with me. And when I went to the restaurant in St. Lawrence Gap night, and I was saying to her, I said to her, but do you have a sister that works in the bank? She said, no, it was me. I know I served you this morning, but here it is. She's a waitress, serving again. She went on to establish business. And I think that she has gone into law at this point in time. So what I have found is that there are a number of people that recognize, I'm not going to make it on my salary alone. So there need to be an extra way of generating cash. And of all the financial instruments that I'm going to say to you, having your own business and finding that extra money coming in is a good move. It's also a good move when we're looking at our children. How do you prepare them for the future? I know with my children, I have 3, I said to them, Skipper, let me get something straight. I got money set aside for university, but I also got money set aside for skills training. You will pick a skill and you'll pick a profession. My daughter was smart. She decided to teach. So she got a skill and a profession together. All right. So my last son, and not that I'm the greatest example, he had a little bit of a learning challenge, initially, but he did skills training. He's at university. because his goal is to be a contractor. So BCC set him on a path that was good. He needs the management training, so he's going UE to get that, but having an appreciation for the skill of itself. So I'm saying that we live in a country where you can put together a package of training that can be affordable, that will kind of put your children in good stead. Even though the reality is that you will depend on them, I think it is important too that you lay the way that it is not too much of a burden. The national insurance, and let me just touch quickly. I'm going to try to wrap this up in a couple of minutes as I move away from the video. The thing about pensions in this country is that they have changed. Initially, when you had a pension, you could be sure if you were working for, say, $2,000 a month, there was a guaranteed amount that you would know before you leave the employment that you will get. The benefit was defined. And if for some reason the investments along the way they didn't come up to par, the employer was responsible for making good on that promise. And that was a defined benefit. Over the years, a change has occurred where we move now to define the contribution. So if you were working for $2,000, $2,500 a year, and you work at the same company and they change from a defined benefit to a defined contribution, the only thing you knew for sure is the 2% you had to put in, the 2% the company would match, and probably the 5% that you can put in voluntary. But you would not know how much you would get at age 65. It would depend upon how the market performed. National insurance currently is a defined benefit plan. And one of the things that concern me is in the options being discussed is the idea of moving that from a defined benefit to a defined contribution plan, where what you would be paid depends upon how the market performs. I am not totally comfortable with that idea at all, because in planning, I want to have a safety first approach to planning. I want to have some sure money that the person can expect. And even though national insurance itself is not a lot and is not really designed for you to live on, it created that floor. Coupled with that is the company pensions. Like I said, some of them are in a defined contribution plan. But the other issue that I recognize is that the employees are asked to choose what particular kind of mutual funds tend to back the plan without a whole lot of knowledge. Sometimes they are guided, but there is that information gap. One of the things I can think safely announce is that pretty coming late in the year, there's a collaboration between the BARAIFA Institute, of which I am the chairman, and BCC, and we're looking to to restart the mutual fund course. In that course, we would also look a little bit about pensions, how that will go. We'll look a little on understanding the financial market. There'll be a little bit of understanding about the insurance. And even though the plan will be designed for licensing for those that want to sell the mutual funds, there will be a component for the average citizen to build that knowledge so that you are well able to make decisions. Opportunities are happening. We find that when it comes to the stock market, there will be more opportunities to trade overseas, and I know a number of companies are gearing up for that. And a number of people are currently doing that. The establishment of the foreign exchange accounts, again, creates the opportunity where you can earn in US dollars and be paid coming in. So that opportunities are happening. The instrument that I want to touch on quickly as well is what happens to the pension. I mentioned before, you buy this annuity. The annuity itself offers a lifetime income, guaranteed lifetime income. So when we went back to the example, and if I can quickly go there again, let me see if I can just new share, come down to let me share this and let me go back to this bit, the click off. The $301,000 at this point in time would have purchased an annuity. The annuity now is what will pay you, and this is what the person will get. And let's say you took the pension at 70. This is what you will get. You took it at 65. This is what you will get. This is a guarantee. This is a payment for life. Now, If the person took this pension at age 65 and the next day died, you realize that 166, 65 coming out leaves a whole lot of money in the pool. To prevent something like that, the annuities come with something called a guarantee period, so that when you are working the pension out, the insurance companies will factor in how long the payments are to be done for. So what is not shown here is that you will know how much money you will get over the lifetime. Couple of things too about the annuity as well is if you have a spouse, and this is where the planning comes into play, you can guarantee a period, like I said, you can guarantee a period so that so let me go back. Let me slow down a little bit. If you have the annuity and you can select the length of time you want, if I say it like that, I'm going to confuse you. Let me go back. The annuity will pay for life. As long as you live, you will get the product. But there's an option which we call a guaranteed period, where even if the pensioner dies, that payment will continue to come in for that particular period, whether that is 10 years, 15 years, some options maybe 20 years. So what that means is if the pensioner dies, the spouse will have that money coming in for support. So that particular product, if the person, retires at age 65, that person can be assured that money will be coming into the family up until age 85, guaranteed. Today, we have the options as well. You can determine, do you want the spouse to get 60% or higher? By law, you can't go less than 60% unless the spouse agrees. The reason you may want to reduce the amount of money coming into the spouse and making that option is if you reduce the amount that the spouse is to be paid in terms of that guaranteed period, you end up with a higher payout. So for example, in a case like this, at 65, it may not be $1,600, it may actually be $2,000 because the spouse has agreed to the 60% payout. You can also have a guarantee period of say 20 years. And again, you can make this amount higher. If you are doing something like this, where you have pension coming in from say an annuity, the guarantee period is age 85, then the debate that I hear now about NIS, whether you start NIS early or you delay the NIS, can come into play. Because if you are having sufficient money coming out of your annuity, and you are conscious that your tax allowance is $40,000, you may want to delay the NIS until age 70, because if death occurs to the greater pension earner, then not only will the annuity provide some money, but also your national insurance now, the survivor's benefit will kick in, so that the survivor then gets the higher pension from in that regard. Now, when it comes to planning, and this is where now the role of the advisor comes in as the person trained to do that. You can make decisions early. Do you want to incorporate, say, for example, life insurance within that whole mix, so that a higher pension can allow you to pay for the life insurance premium. So in event of death of the pensioner, then not only does the survivor benefit kick in, but also a lump sum of cash will come in as well. So that there are instruments, and the planning is important, where you can have these things and decisions made early, that when you are 85, you are 90, at least some money is still coming in for you to be able to sustain yourself, or at least have money replenished in event of death, and then that drain on the family. I'm going to stop here for questions. I don't want to go far, I've gone over the expected time, and I trust that I did not lose you. So let me pause then for questions. Over to you, Valerie.
Thank you very much, Roderick. Even though you keep saying you're going over, I mean, I was paying rapt attention because I myself also want to work on, kind of putting better plans in place for retirement. But thank you again for that dynamic and insightful presentation. So you know, ladies and gents, you know, we're turning the floor over to you. I know Roderick, you know, shared some, you know, some very compelling gems and suggestions, and I'm sure you have some burning questions that you may want to pose to him. And so what we're asking you to do, just so that we can kind of manage the flow, is that if you're interested in asking a question, please raise your hand, and you know, we will look for your hands and call on you and ask you to unmute. If you're a little shy or you want to ask a question, you can also put it into the chat, and you know, one of our team members will we will make sure that we can pose that question to Roderick. So I see that we have a hand raised. Lucy Hall, you can unmute and ask your question.
Good evening, everyone. Mr. Nurse, you would have indicated that you had talked about persons who had both the registered pension plans.
Right.
So based on what you said, if you already have one, you would have to, the only way to avoid that 25% will be to wait until it's ready and then buy an annuity with it. I just want to be clear.
Yeah, wait until it is ready is really the best solution right now. And you will get 25% tax free as a lump sum. You will have that option. And then the other 75%, when you buy the annuity, that money will be paid to you for the lifetime. The whole idea of having the tax penalty is you didn't want people spending it too quickly, and then is not going the distance. So the idea was to have money that will go the distance. And you know, the government and was well aware that if you can ask people to buy the annuity product, it guaranteed them an income for life. So it was really to get to that point. So even without the tax incentive, and you want to continue to fund your RRSP, then you can safely do that. But just don't have any intention of taking out that money, because that is where the tax penalty will come. That is the only thing. What happened before that made it such a nice option? What was that the money that you would put into it was basically tax-free money. You didn't pay taxes on that money. In fact, I shouldn't say, you were getting up to 35% or up to 35% off the first, up to $10,000, a 35% tax rebate when you're filing. And if you took it out, you then had to pay the taxes, which would have been 25%. So it was a fair agreement going in and going out, but circumstances have had to change that. And that is what creates the little anomaly here.
Okay, thanks. And one last thing, you'd also talk about life insurance. So it's sometimes, most times I hear people say when they're going to retire that they may want to look at traveling or something. So I was thinking, at least for myself, I was thinking about making sure I have a plan that I can have an insurance plan in place that when I'm looking to retire, maybe that is when I could probably cash that in. Does that make sense to you?
Well, you see, if the planning is done early, I mean, I know a lady that she had a couple of endowments. This is a particular plan, and she took one, and one was her cruise. You see, the other thing is that coming, say, age 65, 70, you just came out of a mortgage. And, you know, even if you had some money, the house is 30 years old or 25 years old, you may want some upgrade being done, electrical or plumbing. And that insurance payout is a way now that you can not only go cruising, retrofit the house. It wasn't money you were planning for. You know, you were not budgeting on that. So using that money to retrofit the house or anything at all like that, you find that it will come in, it serves its purpose. There are sometimes some other things that I have seen where for surgeries, sometimes pulling on that cash value is what was used to pay for surgeries. So the planning and planning early, yes, the life insurance can be used for things like that, but you want to fit it into a plan.
No problem. Thank you.
Thank you, Lucy. We have a question from Stephanie Boisner. So Stephanie, if you go ahead and you can unmute.
Yes, good evening, everybody. It's just information I wanted to share. because I am one of those cliquot persons who then had to buy the bonds after the company had more or less gone out of business. And in purchasing the pension plan, I had a grand scheme for my retirement to come at age 55. And therefore, now that the payments are being made to me, the interest payment is being taxed because I chose to get the pension benefit before I reached the age of 60. So that's just some information I want to share with persons who are younger than I am, that as it was that Mr. Nurse was talking about being double taxed. Now here it is when I expect to be paid what I am seeing on the schedule document that was provided. What is coming to me is actually less because there is a tax component that is applied before the payment is made. So I just wanted to share that.
Yeah. Once their dividend payments, I think that is like 12.5%. But and you see the thing too about when you are getting payout, well, not insurance money is not taxed. When you're getting the annuities and that money coming in, and you are over is 60, then I think it's 60 or 65. You then get your allowance is more than 25,000. It is 40,000. So you're fine. You know, there's still a little bit of tax savings building that, but that is one of the things you want to watch for. The having to pay taxes. It's interesting. We don't have as many, even though our system here is, especially income tax system, is based in part off of Canada. From what I see, looking at the Canadian tax system, there's a way in Canada at which you can have income splitting. So when you reach your retirement age and you are the greater earner, you can split your money with the spouse who might be the lesser earner, and so defer some of those, you know, reduce some of your taxes by letting the lower income earner then have a share in the income coming in. I've been checking. We don't, as far as I see, we don't have that facility here.
So, Roderick, I don't see any hands raised at the moment. I mean,
Okay.
so I guess kind of following on the theme of in terms of taxes. So, you know, what are some of the things that, I guess a retired person can do to kind of, minimize their tax burden?
Unfortunately, there's not a lot that can be done. In our tax system, apart from apart from if the spouse wasn't working, that was $3,000, just going back to what's generally available. I can recall the health levy, which is $750. I did not see a whole lot, and a number of things would have been taken out in terms of allowances. So I can't recall much that you can do to get away from the taxes, especially if at retirement you are still generating, you're generating sizable income. Other than probably looking for investments. Some people running a business will still allow a lot of the cost to go through the business, and just take a very small salary, and a lot of the expenses are covered. But even within our tax system, if you are working for a certain amount of money and you are given a car from the company, then a percentage of the value of that car is still assigned as income, and then you are taxed if you have the use on allowances. So the government is pretty comprehensive in getting its tax money.
Okay, another question I had for you, because we have this this idea in terms of the type of investments we make at different ages, and so let's say somebody, maybe around my age, which I'm not going to share, somewhere in the middle, and, you know, unfortunately, who did not plan for retirement early. What are, you know, other than obviously, you know, starting a business, which you suggested in terms of having your quote unquote side hustle, you know, what are the other options in Barbados in terms of helping to, you know, build out your, you know, a larger retirement package for yourself at the end?
In listening to the central bank, First Caribbean invested the $100,000 in the bonds. That made news. I also heard the person presenting said that the Treasury notes, those 3 and 6 months instruments, will now be available to the individual investor and not simply the institutional investor. So that instrument becomes a way in which, you know, you can have money turning over in the short term as well. So that was a good move. The bonds, I think the confidence, you know, is being restored. The reality is we don't really have a lot of other areas in which to put money. So the bond market, to my mind, will pick back up. The fixed high interest savings in, like say, the credit union, I look for where you can get the highest interest save. And the thing about, for example, the credit union that I recommended for a long time is that the charges are significantly reduced. Part of what I suggest people do, and not necessarily invest in money, but go to a place where you can save yourself some interest, is something that you may really want to do. If you have the additional money, then use part of the surplus to pay down debt. That in itself is a significant move. Sure what I mean?
Sorry, you're there, Roderick? Okay. Yeah.
This one open up. I just wanted to get this out there. Right, you can see the screen?
I can.
Okay, the amortization schedule, right? This part of what I designed, this is one of the tools that I would use in planning. And you can see where, for example, if it's a $235,000 loan and you're looking at 3.25%, but you can see where the interest and principal will come about, but you're still paying a significant amount of interest here. If you can simply redirect some money to the principal or make those payments twice a month, as you would say, you know, you can save some money. The other bit is if you can have a target, and this is how I suggest people set the target. You know that 30 years, you're paying $1,000 a month at say 3.25. If you can have a target of paying off the mortgage and I want you to look at the interest. If you can have a target of paying off the mortgage earlier, you're paying more. But you can see that there's a significant saving when it comes to the interest you are paying out. Now, you may not be earning money, but you definitely saving on interest. And the thing that I really want people to recognize is that if you are paying a loan for 3.5% or something like that, and you can pay it off earlier, that percentage is what you are in essence saving. So the mortgage is relatively easy. But one of the things I suggest people do is if they find that they have the high interest loan, those payday, quick cash kind of loans, then you can look at consolidating. I remember this credit union a few years back, and I at the time asked the credit union if I could use it, because it was already done, and I didn't have to do anything. Where there was a product that looks at $30,000, and the $30,000, the interest being paid and the repayment took $1,752 out of that pay of the person, and there were a number of products that showed the loan. The $30,000 loan from the credit union at the time, the rate was 10%. That payback was $500 and something. And that made a significant dent in what the person had the capacity to do. Because you've gone from $1,700 down to $500 a month. You are paying a lower interest rate, and that was the benefit. Because the 10% loan was a significant saving over the 30% loan and the other high interest loans. So sometimes you may be looking, and I unfortunately see people do that. So you know what, I want to buy bonds, and you carry in debt. I'm saying you can't look for savings when and get 3-4%. You know, when you are carrying some 17 and 20% loans. What you attempt to do is you want to reduce your loan portfolio. You want to get that down because there's still significant saving, even as you can see now over the 20 years, or let's say that you were looking at the mortgage at say 6%. You can see the jump in interest rate. So you want to see, can you get a lower interest rate at any time? And the nature of the product will compete with retirement money. Because here it is, you start out by paying $235,000 for a product. The interest now brings that total cost up to $356,000. And if you look at how the amortization schedules go, that on 1983 paid out 1175 is interest, only 808 gone to principal. So at the end of the first year, you can see $23,000 paid in. $13,000 is what went to interest, $9,000 went to principal. So even though the loan is on the reducing balance, the faster you can get this balance reduced, the better for you. And you really want to do this early. You don't want to carry that into retirement. You're really trying to avoid it. So when you can make concessions now, you decide, you know what, let me find something, that you're not going to buy the pair of shoes as a man, or I'm not going to get my car clean as a man. Then I have money to put there. I am married, so I don't use the example with women cutting back at all. I like my life happy. So as a man, let me cut back my shoes and things like that. But you do find where you decide, let me put the money towards the principal. And it can come down. I think, Valerie, you can confirm that there is no, or rather, is there a time frame that the person must be paying a mortgage before they can pay towards the principal?
Sorry, I am not versed
I
in
think
that
Lucy,
area
as far as I know,
answer,
no. As
but,
far as I know, there's no,
Roderick,
you can do it from the beginning.
what I was going to say is that our chief operations officer is on the call. So Marie,
Okay.
if you could unmute for a
Yes,
minute
she
and
can.
answer that question, that would be wonderful.
No, there is no penalty. So you could start paying towards the principal as early as you can.
Correct. And you can do the paying twice a month to reduce the interest.
Yes, you can.
Right. And you still got that special loan at 10%.
Pardon me?
No, I was looking at that product. That product is what I recommended a lot of people. And the other thing, you don't have to wait until you are in financial difficulty to consolidate. Sometimes the best time to consolidate is when you have the financial strength. If you realize that the payment is too high, then you know what? Create a little space for yourself. Decide to go in and consolidate, pay a lower amount, and you have money to put towards savings. So there are some approaches that you want to take. You try not to add debt on debt. The facility that I know I spoke about at the credit union was the risk-based lending, so that people that would normally be declined, they have a greater chance of still getting the loan, albeit you're paying a slightly higher interest. Compare that with going out in the market and getting a loan. One of the things you want to be very mindful of is the interest that you are paying. So it is not a question of what's the payback. What you want to know is what cost am I buying money at? Am I buying money at 6% or am I buying money at 3%? It makes a significant difference to what you're doing. You see, so you want to be sure in that regard. So 6%, you pay $121,000 in interest. If it was 3%, that dropped down to $57,000. You want to ask the question, how much interest am I paying on the loans? So yeah, if you can't find investment opportunities, pay down debt for sure, and try to hold cash. I think COVID would have taught us that lesson. So that is one of the things I suggest people do.
Well, Roger, speaking of holding cash, so I just want to remind everybody here that the credit union has a number of different savings options available to you, as I shared earlier. And we have a savings option to meet every need. You know, we have this concept of step up your savings. So if you only have $100, we have an account for you. If you have 100,000 and you're looking for a better return, you know, we have what we call our and premium type savings deposits, like our term deposits, which carry, you know, higher interest rate, and it, you know, you hold your money for a period of time for you to consider. You can feel free to go to our website, www.bwccu.com, and all the information on savings is under personal solution, as well as any information on the credit union that you may be interested in. And just to remind you again that, you know, we have introduced a new Smart Living Retirement Savings Account, and you know, that is our answer to the reduced benefits and the challenges with the registered retirement savings plan. And again, you know, if you're interested, you can come into any of our branches and speak to any of our team members to learn how you can sign up for any of those accounts. So I just felt I would take that moment just to remind everybody. Let
me add one thing there, because I spoke about the annuities and I spoke about the pension plans rolling over into the annuities, and I used the example with the proposal from CLICO at the time. But the annuity is a product that if you sell a house, a car, you talk about your savings, the same you're saving at the credit union, you then can come and bring that money over and say, you know what, I have this money, you know, Valerie's $100,000, and I want to see how much payment will come in off of this $100 and that $100,000, and that can be worked out for you. So in your planning, you will know that, you know what, I have this money coming in, and it's not going to change. That is there. So the annuity is a product that you can, you know, you can accumulate in one vehicle, and then you can come and purchase the product, and it is all managed. So that is a good thing too.
Thank you very much for that, Roger. Are there any other burning questions? Anybody has a question that they want to ask? See that we have gone, oh, sorry, we have two hands raised again. Okay, we'll go with Lucy Hall. You can go ahead and unmute and ask your question.
Right. My question is in terms of budgeting for, I was trying to do some projections for when I would when I retire, and I've realized that you actually go skeletal in a way. Because so that's something that I was saying, that's something that people have to bear in mind, because you don't really have money unless, as you say, unless you create another stream of income, you will have to be very, very strict in the way how you are apportioning your money. That's what I wanted to say.
Yes, and the habit starts from now, right? That is an important aspect of the whole idea behind retirement. I was actually looking for the budget side. Let's see if I have this one. It's not declared, but and remember that retirement is long-term planning, and that's what you're really doing. So I'm saying if you're working, and I took the interest out because trying to project your interest rates and looking at what it may earn over time, it doesn't help. It really does not help. So if I look at hard cash and you put in, say, $3,000, and you work and you're working for $3,000, you're spending $3,000. In 20 years, you will spend $720,000. That is basically what this is saying. So if you are having a retirement goal, you're either able to accumulate the 720, or you decide, you know what, let me get an apartment paying $600 a month. Now over 20 years, if the person pays well, and if you are budgeting for an apartment and you're budgeting $600, then your rent will probably be about $800 or $1,000. But I expect things will come out when the person move out. You may get a bad tenant that give you a little bit of stress. But you could realize that over 20 years, there's $144,000 that you have coming in. So sometimes you talk about a person building a house and putting on an apartment, and the question is, will that make sense? Then I tend to use this tool. I know it's a little bit probably hard to see. any plan to go through it, but it's a little hard to see, but don't worry. I tend to use this to work out if the money that I am borrowing based on the rents you expect to get over a period of time, if it is worthwhile. So you can have, Lucy, where you got a set of apartments, or you add on something that will still bring in money, and this is bringing in money every month. So there are opportunities that you are looking for to generate cash. And why this may be a whole lot safer is even if you put money in the financial markets, a market crash will end up with some losses. The whole investment in bonds and shares over the years, we learned that, you see. So you want then to accumulate some money, be able to buy the annuity, because that is pretty much guaranteed as the nature of the instrument, and that is backed by sufficient regulation as could be possible. And then your other investments, like this would be a farm I was working on at $600 a month. So this is just some of the ways. And budgeting for sure. It is a habit that we really need to get into as a people. I also designed one because, and this was for me. So this one is a little bit, your wife complained it was complex, but she kind of adjusted to it after time. It works. Where, let me go to the top. Right. Where you can use an exercise book. You got to project your spending, you know where you can spend beforehand, you know what the actual amount is that you're looking at, and you know, okay, where you're buying the food from, where you're buying the gas from, anything that helps you know before you start to spend any kind of money at all, how much money I am going to end up spending this month. One of the things is that if you're going to be broke, you know from the first of the month that you're going to be broke. So you can make decisions, don't do the extra spending, because it is simply not there in the budget. And there is no company in Barbados that operates without a budget. You must embrace the concept of using your home as you would run a company. So yeah, Lucy, thanks for that. That is an important component when it comes to budgeting, and also looking for opportunities that you can continue to earn without much of your input.
And thanks for sending me the budget in advance.
Okay, I will. In fact, I got one that, and I put a shortcut in it because every month I ain't going through creating the budget over and over, but we got another hand.
So Roger, is that template something that you're willing to share? I'm putting you on the spot.
Yeah.
No problem. That we can share that with all the persons who attended today.
Yeah, let's see if I can.
Yeah. While you are figuring out, we also have a hand raised from Stephanie Boyce, nurse again. So Stephanie, if you want to go ahead and make your comment or ask your question.
Yes, thank you, Valerie. I wanted to go back to Lucy's question, because Mr. Nurse, you told Lucy what she could do with a lump sum that she could very well be paid out from an endowment. But I also listened to you earlier, and we all know that we're living longer. And you talked about not relying on the NIS. And what I wanted to find out from you, that insurance product, because I don't want to use my money to repair a home or something like that. I want to make sure, as you were suggesting, that for the length of time that I live, that I will have a decent amount of money to support my living and not having to rely on my children to look after me. So is there that insurance product? And you spoke too about how they are regulators and how much more secure now insurance, the environment for insurance companies to operate. So I want to find out if there is that product that I can go to, so that, let's say at age 65, I know that I'm, yes, going to have a lump sum coming to me, but the product can continue for a little longer, that even although I may not be alive, then I can still have something for my children as well to benefit from. So I am looking for a living benefit as well as something that I can pass on.
Okay. All right. I'm frozen here. Let me see what happened here.
I don't know if it's happening from your end. I'm not hearing you very well.
Right. I was actually stuck. Let me see if I have too many resources open. You can hear me?
We can hear you.
Okay. All right. Because I realized that the screen froze just now. So when it comes to planning, and you could appreciate that the needs are different. Lucy talked about the endowment, and I made reference to that. But sometimes that product in itself will have certain weaknesses. For example, if you were getting $100,000 today, where are you going to put your money? So there are certain insurance products that carry with it something called reinvestment risk. Because even though the payout happens, where do you put your money becomes an interesting question. There are other products that are designed to mitigate that reinvestment risk. You may have some products that at 65, you stop paying premiums, and that continues to build based on the actuarial projection. And the products will suit the particular person. Sometimes, like Lucy was saying, she's getting to the age now where, she may be looking towards retirement. But very early in life, when you were in that accumulation phase, a product that didn't build any cash value at all may be what was better for you, because at the time you needed to look after children, you needed to find transportation. So it wasn't suitable, even though there would have been a plan in place that by the time you get, say, age 40 or so, you then can change the product. So that when it comes to planning any of the products, there is no one good product. There are suitable products and suitable products for stages, and that then become the basis for planning. So, but where it is now that you get into age 65 and the person has a couple of, you got a couple of endowments, a desire to travel. That desire to travel may have to be tempered with the reality of, will this money last you until age 90 or so? What is your current health situation? Are you struggling and dealing with diabetes and managing diabetes? Because if you have an illness that you have to deal with, then understand what may occur. Are your parents alive, and your mom and dad, are they well off? Do they have medical insurance, or will this money have to be used to address a health issue that may be coming up? So yes, there is a desire that you work hard, but very often when I'm, as a planner, when I look at a client, I have to look at that client's entire life, which will include the children, the parents, anybody you have responsibility for, then to determine what is the best use of that money. So sometimes you can't travel, Lucy. You're gonna stay put. So I understand the question, but it really is specific, and it really has to. You really got to sit down and do a thorough analysis, because you can miss if you don't do it properly. I hope that answers the question.
What I also want to say to Roderick is that you got to say these things early, because buying insurance plans when you get older is going to be more expensive as well. So
you better be in good health.
yeah, well, yeah.
So you definitely want to do some things early.
And now that, right, I was going to say, speaking of health, you also got to look at a proper insurance medical plan as well. I guess that's what Barry want to allude to.
I was gonna say that we have our Healthy Living group insurance plan. So again, for those of you who maybe don't have medical coverage right now or looking for a good option, you can certainly speak to our credit union representatives to get some information. And in fact, we have a special enrollment going on presently, where if you're under 35, you can actually sign up or join our group health plan without having a medical examination once you meet certain stipulations. So, you know, we're putting many options in place to kind of ensure that our members are well covered, you know, as it relates to, you know, proper financial planning. And health insurance is really a key component of a good strong financial plan, because you know, if you have a medical emergency, it is scary how quickly that can wipe out your your even not so limited resources, depending on what the issue may be. So you don't want to leave yourself open in that regard. You want to make sure that you're well covered. But at this point, we're actually now at 7:28. And what I would like to do now, because, you know, at the beginning of the session, I promised that I had, you know, a couple of credit union vouchers to give away. And so we're going to make this very quick and easy. Very easy questions, hopefully, if you're paying attention. I would like to, you know, to offer the person who can tell me what is the name of our new retirement savings account. I said it a few times today. If you can just raise your hand, it's as simple as that. First person to raise their hand and answer it. It cannot be a staff member of the credit union if you are on the call. We are ineligible for our own giveaway. So anybody can tell me the name of our new retirement savings account. Anybody? That means we're not giving away the voucher today. I don't see any hands raised. Oh, we have a hand. So Stephanie, you can go ahead and unmute and let us know, give us your answer.
I'm going to take a stab at it. I think it was Smart Living.
That is correct. So Stephanie, if you share your contact details, if you private message myself or a Darian Broom, who's also on the call, we can make sure to get that in your hand. I have one last question, and hopefully this one is even easier than the last. And Stephanie, so we'll give somebody else a chance to win that voucher. If you can tell us how many branch locations the credit union has, you'll be the second winner tonight. Okay, I think we have a quiet audience with us tonight. Nobody, no takers. Oh, we have a hand raised. Rochelle, hope I pronounced your name well. Go ahead and let us know.
Branches?
Sorry, say that again for me. I missed that a little bit.
Sorry, there are 3 branches.
You are absolutely correct. And it's as easy as that. So Rochelle, you are the recipient of the other $50 credit union cash voucher. If you're currently a member, you're very welcome. So again, if you can just private message us your details so we can make sure to make arrangements to get that to you. So again, if you're a member of our credit union right now, we'll make arrangements to have the money transferred directly to your account. If you're not a member at the moment, we will arrange to get you that cash voucher. And
that's fine.
Okay, brilliant, wonderful. And thank you so much for joining us tonight. And so, ladies and gentlemen, we're now at that point in the evening. We had a really great session, but as they say, all good things must come to an end. And so first, on behalf of the BW Credit Union, I want to extend my sincerest gratitude again to you, Roderick, so readily agreeing to be our featured speaker for what we know is a really important session. And, you know, I hope that we can continue to work with you. You know, we do have some younger credit union members. We've actually launched a new Smart Youth Leaders Club. And these are some of the things that we want that young generation to be familiar with as quickly as possible so that they have an even better chance of really being able to kind of work towards, you know, that path towards financial freedom. So again, we want to thank you so much for giving us of your time and sharing, you know, your expertise on this topic. I want to also say thanks to the, you know, members of the BW Credit Union team who would have been working with me to make sure that today's webinar came off successfully. And finally, of course, I want to extend, you know, sincere thanks to each of you for being such an attentive audience tonight and for blessing us with your presence. these sessions are really being pulled together, really just to kind of help our members and prospective members be better and do better. So, they will only work if you are here. Before I close, I want to continue to, rather want to encourage you to stay connected to the channels of the credit union. If you don't follow us already, please know that we're on Facebook, Instagram, LinkedIn, YouTube, and now even on TikTok. And you can, of course, also visit our website, www.bwuccu.com, to get, stay updated on, activities, products, and events within the credit union. And so, all that's left for me to say, ladies and gentlemen, is thank you for your time and have a wonderful good night. Goodbye.
Good evening, everybody.
Good evening. So Rochelle and Stephanie, if you haven't, I guess, because I was busy talking, so I'm going to make sure that we got your information from you.
Good evening, everyone.
Good evening.
I just sent mine. I'm not sure if you can see it. I think I sent it to the right person.
Hi, I am seeing it, Rochelle. And you said you're a member, so we will. Rochelle, you don't happen to know what your member account number is, would you?
35053.
Wait, okay, well, you're telling everybody, but good news, all they could do is transfer money to you. We have your account fully secured. Let me, you said that a little quickly, so let me just let you slow that down.
I'll type it in for you.
Oh, I appreciate you. Thank you very much.
No problem.
And Stephanie, did you share your information? Oh, I see it there, Rochelle. Thank you very much.
No problem. You have a good night. Everybody have a good night.
Have a great night.
All right, T.
Good evening, everyone.
Good evening.
Nice program. Continue the good work.
Thank you very much.
You're welcome. And yes, I am a member.
Okay, and that is good to know too. Thank you. Good to know that our members are benefiting from these events.
Yes, of course, indeed.
I'm going to. Oh.